Billionaire Warren Buffett's best investment advice ever.
It's Brian Preston, the money guy.
Brian, I am super, super excited about this show because
I'm back.
you are back. That's the reason. That's what got me super excited. No, I'm so excited because every year Warren Buffett does this wonderful thing where he says, you know what? I want to write a couple 100,000 of my closest friends.
You think it's only 100,000?
Couple million of my closest friends, my other shareholders, and I want to just kind of tell them my ponderings, my thoughts, what I'm thinking about, what's been going on at the company. Because really, we're all partners. We're all co-owners. He doesn't even call them investors. He calls them his partners who own Berkshire Hathaway stock. And so he drops just this wonderful piece of literature every year that we're able to just read through. And I, for one, thought that this year's was fantastic.
It is interesting to me. You know, Warren is 90. Charlie Munger, his partner, is 97 now. I've already told you guys, I'm in my mid-40s, so I'm sentimental about things. I'm like, I love how Warren pontificates every year, and that's why we cover this. You know, I know he always releases it right at the end of February. We usually cover it right in March. It's to savor it because, I mean, I know these things won't continue forever, so it's pretty awesome to kind of take some life advice, figure out how you can apply this to your own personal finances, and then run with it. And that's what we've really put together today. We shifted, and this, I give Bo a lot of credit to this. A few years ago, we shifted and we said, hey, what can we start taking from Warren Buffett's letter to shareholders and apply to your personal finances so that we can actually turn this into teachable concepts from a billionaire that you don't have to have that many zeros after your net worth and still find a lot of value here.
And it's amazing how, even though some of his writing, you know, he's talking about very complex, very deep things, it's relatively simple. So you can read the letter and just get value out of reading it. Just kind of, you know, Google Berkshire Hathaway 2020 letter and you can kind of pull it right up. But it's amazing. If you read it and you think about some of the lessons behind the things that he's saying, it kind of opens your eyes like, wow, no, that is applicable. That does apply. That does matter.
You'll also see he spends zero money on his web design, updating the web design. It's still 1997 on Berkshire Hathaway's website. So let's talk about number one. This is the size of your shovel matters, but how you use it actually matters more.
Yeah, we talk about this all the time in personal finance. You know, Warren, when he started his letter, he basically started walking through Berkshire Hathaway's income statement. And he said there's two sort of ways that they generate income, that they have revenue come in. One is through the earned income of the businesses, the operating profit of the businesses that they run. You can kind of think about that like your personal household income. That is your, you know, what shows up on your tax return on your W-2. Well, the second piece he talks about is their army of dollar bills. And he doesn't call it that. That's what we call it. But it's basically the investments that he has working in the background with the cash flow that Berkshire Hathaway has.
So so many people out there who get you caught up in the behavior of building wealth. Look, the size of your shovel, meaning your income, is definitely important, but we go beyond that and we talk about, because we have this abundance mentality, that we think actually building wealth is an endeavor anyone can accomplish if you just start young enough. And Bo, you had a great pop quiz that you kind of want to go over with everybody.
Yeah, this is something I think we lose sight of when we think about the size of the shovel. So I'm just going to read this to you. Okay, this is math, so you know, think about it, get pen and paper. If a 20-year-old professional athlete signs a $10 million deal, right? He's going to get a $10 million income deal. How much does that 20-year-old need to save per month to be a millionaire by the time that they're 65?
So investing, because we use the word saving, investing interchangeably here. But you're saying, even though he signed a $10 million contract, how much does he need to invest monthly to reach $1 million by the time he's at retirement?
So I want you to think about that one. And then we have sort of a part B, a second part of the question. If a 20-year-old college kid, not even graduate, but a 20-year-old college kid wants to be a millionaire by the time that they get to age 65, how much per month does the 20-year-old college kid need to save to be a millionaire by 65?
Now, first, life advice for the athlete, probably it's not how much you just invest, but how much you don't spend,
how much you don't
too,
spend,
because there's a lot of, we tell the woeful stories of of athletes that have multiple seven figures or performers who have multiple seven figures and somehow still are penniless at the end of their careers. Well, the obvious answer, when I saw you put this in the show notes, I was like, I see what Bo's doing here. He's kind of playing the game of, it's all a joke. It's not what your shovel is. It's what you actually end up with. The income is important, but you can do a lot with a little if you actually deploy your army of dollars into investments. And we actually have created some slides on just showing you how approachable, how easy it is to create abundance and wealth for yourself.
And so what we show is that for both of these individuals, both these 20-year-olds, all that they would have to save is $95 per month, starting at age 20 all the way till 65 to be a millionaire. Well, what that means is over the course of their entire working career, they will have only saved about $51,300. And yet, their portfolio would be worth $1 million. That means that 95% of their $1 million actually came from their army of dollar bills working, not from what they had to go out with their shovel and generate and create. It's more about the behavior than the income.
Go through 30, 40, 50, and 60 really quickly just to show that it's not just a young, super young person's game. I mean, look, even a 30-year-old, 89% of your wealth is probably going to come from your army of dollar bills working harder than you do with your wages, your back, your brains, your hands. Even for a 40-year-old, 77% of it is coming from growth. 50-year-old, 55%. And then even for that 60-year-old, somebody who's quickly approaching retirement, you still have the chance to add, close to a quarter of your growth can come from just letting your army of dollar bills worth. There's never a bad time to start. And then a lot of you guys, because we just did an inflation show, the trolls always come out and go, $1 million. $1 million is nothing. I can tell you from several guys who know what it's like to manage, build, and work on seven figures. The easiest way to get to 5 million, the easiest way to get to Deca-millionaire status, get to the first million first and let your money work. So before you're a hater on the million, let's get there before you start throwing rocks at it, because it is very valuable to watch that army of dollar bills work in the future.
So the first big takeaway that we took from this year's letter is that anyone can build wealth. Don't let yourself have some limiting belief that if your shovel's not big enough, you cannot be wealthy. That's not true. It's all about the behavior. It's all about getting started. We talk about this all the time. The absolute best time to start investing was yesterday, which means today is the second best time to start investing and getting your dollars working for you.
Let's pivot on to number 2 here. Here's what I think is interesting. I think I talk about superpowers, financial superpowers all the time, and we try to share those with you so you can make a mental note and make sure you're using this for your own finances. I think this is, besides, like we did a show recently on goal setting, but it's, there's another superpower. I think it's number 2. It's okay when things don't go your way. You can find silver linings in bad situations. And Warren talks about that.
Yeah, he kind of starts off his letter. In the opening, he acknowledges that Berkshire kind of has 2 goals each year. One, they want to increase their operating earnings, the income that they generate. And 2, they want to add new assets to their balance sheet, whether they're investing in companies or buying new companies in whole. Well, he noted that in 2020, he actually didn't do either one of those things. He did not buy any new companies in 2020, and operating earnings actually fell 9%. So for the dual mandate that Berkshire has, he says, hey, you know what? In 2020, we failed both of those things. We did not hit either one of those things.
But it still didn't derail long-term success for Berkshire Hathaway. He used this as kind of a learning experience or a disclosure of, hey, this is what I've learned. I've made mistakes, but I've also learned from mistakes in the past. And that led to some unique things. I mean, I've had life goals of, Bo, I always thought I was going to retire in my 50s. I'm not, by the way, so nobody gets scared because that's getting closer than I ever thought. I thought I was going to retire in my 50s and go become a college professor.
Sure.
Little did I know that desire to be an educator to the masses the Money Guy Show is now a much bigger platform than I could have ever created being a college professor. But you were there front row sitting when I tried to start Advisor Skills, and you were right there with us with Cheryl Holland, a super powerhouse advisor out of South Carolina. And it never got a lot of traction. I think we were a little ahead of our time.
Early,
We still learned a lot from it. But here's what I love is that you look for silver lining moments. I bought a second microphone for Cheryl to use. After the advisor skills didn't pan out, I had this second microphone. I invited Bo to come on the show. And the rest is history. It's kind of amazing. And then I think it's interesting that we got hired by Progressive Commercial to do that 8-part series for over-the-road truckers on good financial management. It was, I think, a good project. I think we thought this was a big break.
Yep.
We were going to get
be the
all
big one.
kind of big discovery moments when people realize, hey, these guys are giving great advice to truckers. What could they do for us? It kind of sounds ridiculous now, but it is one of those things where we were required to do 2 videos. Doing those 2 videos created the opportunity for us to discover we ought to do YouTube videos. And that's kind of become the biggest driver of a lot of our recent success. So keep your eyes open. Even when things in life don't go exactly as you planned, there might be a very teachable moment for your long-term goals.
Yeah, that's an important takeaway, is that you want to begin with the end in mind. You want to actually know what your goals are. So even though in 2020, Warren did not hit either one of the mandates that Berkshire had, he was still able to add value to his shareholders through buying back shares, through retained earnings. He was still able to achieve his ultimate goal, even though it wasn't exactly the way that he wanted to. We all can do that in our own personal lives as well. If you actually have your goals written down and you know what it is you're working towards and what the ultimate purpose you have is, when life throws you curveballs, you're going to be ready to adjust. You're going to be ready to pivot. You're going to be ready to go, okay, a little off course, but correct course and get back moving in the direction you want to be moving.
You give an analogy. I've heard you use this in client meetings. I think you've used it on the show before, is that I think a power of this is sometimes you need to have the strength to recognize what you're doing is not working.
That's right.
So you can actually alter course.
That's exactly right.
And you make the analogy of a bicycle that you need to push or drive uphill, but with a flat tire.
That's right. Yeah, we say all the time that if you have a bicycle and you're going through a valley, right, and as you're going down the valley, you hit the bicycle gets a flat tire. Would you ride that flat tire back up to the top of the mountain before you change it, or would you change it and adjust and make a different strategy at the bottom of the mountain or the bottom of the valley? You would make a different strategy. You would change that tire. You would adjust so that the course, you're ultimately still going to get to the top of the mountain. It's going to be a lot easier if you adjust given the circumstances that you're handed.
I've thinking about life. Now, this is out in investments. Is like get rid of your losers so you can actually move to better ground with your investments. But I think about this in terms of life is that I've worked with a lot of successful people, not only with managing money, but also in life. When I was on a school board, I remember some of the superintendents I worked with had made lateral moves to set them up better in their career. We have seen career changers come to our firm who have had success in another career, but then they realize, hey, that's not where my passion is, and they've shifted it, made a lateral, even a step back sometimes to power forward to the next level of opportunity. Pay attention to that. It's okay when things don't go your way. You can still create some success.
Yep, absolutely.
So let's talk about number 3. And this one is very much, I think a lot of you guys who are sitting there, if you got the Cheetos and you got the orange dust on your fingers and you're watching this content, you're like, hey, I'm going to like this one because it's number 3. Investing is great for lazy people.
Yeah, this one I get so excited about because, as you know, one of the things that's beautiful about these live streams is there's a live chat going on, and I'm able to kind of glance over and check out the live chat. And one of the things that I keep seeing you guys say is, oh, yeah, well, no, Warren does it different. He buys whole businesses. It's different. He's not really an while it is true that Warren does have the ability to go out there and buy whole businesses, and that sometimes they do that. That is not exclusively what Berkshire Hathaway does, nor is it exclusively what Warren does. A lot of times, he chooses to be a lazy investor, and he actually has a great quote that ties into that. He said, "It took me a while to wise up, but Charlie Munger, his 97-year-old business partner, finally convinced me that owning a non-controlling portion of a wonderful business is more profitable, more enjoyable, and far less work than struggling with 100% of a marginal enterprise."
Yeah, I think, now look, they do have a lot of success where they have taken entire companies.
Sure.
But that's not always the easiest thing to do. And you see that. Warren, if you go read the letter to shareholders, you're going to notice some of Warren's biggest holdings is Apple.
Yep.
I mean, Coca-Cola.
Yep.
American Express. I mean, it is not anything crazy for Warren to look around and say, look, just like he did in 2020, I didn't have any businesses to go buy this year that I thought were fairly value or have a good intrinsic value. So I went and I just relied upon this passive investment, essentially. And guess what? Here's the cool thing I like. This is exactly what index investing is.
Exactly right.
When people get excited about, like, Tesla had their big run in 2020, had this huge, run up in the stock market. And when you look at, some of the tried and true growth players in technology, whether it's Google, Apple, even Microsoft, and you go, when do I get into those things? Or Amazon? When do I get into all these things that are in the news for how they handled the pandemic, how they've grown and prospered through this? If you're buying the index, you already own it. You didn't have to outsmart anybody. You just were there, and that's what's the beauty of buying index funds is that you don't have to get cute with it. Just the behavior of buying the index funds is going to get you in some of those top performing investments automatically.
So the takeaway that we took from this is start investing today. Go ahead and be lazy today, because every single one of us, when we make our 401k contribution, when we fund our Roth IRA, when we put money into our taxable account, we have the ability to do exactly what Warren Buffett is talking about. We get to own minority interests in very, very good companies or very, very good indices without having to go take over the company or start a business or become the CEO. And over time, it is highly likely that you as an investor in those businesses will be rewarded.
That leads to number 4. Bo, this one would be on the Greatest Hits album.
Yep.
It's almost like when Warren drafts his letter to shareholders, he has a skeleton checklist of things that must be
That's got to be in here.
every year. He goes through, he writes it up, and he's like, wait a minute, we almost forgot it this year. Let me go back and I got a whole list of quotes here. Let's see which one we're going to pull. And it's this lesson he teaches pretty much every year. And it's number 4. Being a contrarian is very profitable, and it can allow you to do things that others will not do.
Yeah, what I think is so interesting is Warren, not only does he say this in every shareholder letter, you've probably even heard he has a famous quote that he says, be fearful when others are greedy and greedy when others are fearful. Or maybe you listen to Dave Ramsey and you hear him say, live like no one else so that you can live like no one else. Or maybe you're a sports fan and you've heard Jerry Rice say, today I will do what others won't, so tomorrow I can accomplish what others can't. It's this idea of I'm going to do things differently. I'm going to manage things differently. I'm going to move in a different direction than the herd. And Brian, as I was going through this, I thought, Brian kind of has a thing that he talks about that fits in this same line of thinking, fits in the same line of thought.
Well, I think a lot of people, what I love about our channel is that people, if you're listening to this on the podcast or on YouTube, you're like, that's great, but what do I actually do? Where does the next dollar actually need to be deployed so I can have this contrarian's mentality and actually accomplish my financial goals? We created it. We have the financial order of operations because I want you, if you can understand, if you follow the financial order of operations and take just a little bit of today's happiness, just a little bit, I'm talking about a sliver. I still want you to use the lion's share to live in the life that you have, but you will be able to build that great, big, beautiful tomorrow of the future, and these 9 steps are going to get you there.
If you want to see the free deliverable, you can go out to our website, moneyguy.com/resources. You can go get the free deliverable, print it out, put it on your bathroom mirror. If you want to know a little more, you can go check out the course. You can go to learn.moneyguy.com to check out that. But you may be asking, okay, well, I don't understand. How is that contrarian? Follow the foo. Why is that contrarian? Well, we know it's contrarian because the statistics show us that 59% of Americans have less than $1,000 in savings. And if you have less than $1,000 in savings, I'm going to argue that you are not following the financial order of operations, because pretty much step 1 gets you there, gets you really, really close.
Well, what Warren does in this year's letter to shareholders, he talks about the fact that bonds are kind of scary right now. It is not the greatest time to be a bond investor. And unfortunately for most insurance providers, because of the structure of their financial statements, their balance sheets specifically, they're kind of stuck having to make some really horrible decisions on how they put to use their excess reserves. Warren brags about the fact that he has such a stable balance sheet that he's able to go more on the equity side of what he does with his excess funds and really try to maximize the opportunity. And the same thing can happen to you personally. If you will focus on risk mitigation, that's why the first step of financial order of operations is deductibles covered, is making sure that there's not some little thing that's going to throw your financial life in the ditch. You can then later, the more stable you are financially, the more risk you can do comfortably because you're not worried about losing your job.
That's
you're not worried about, if you're in a car accident, if the water heater goes out in your house. All that stuff has been accounted for so you can let your army of dollar bills actually grow as efficiently and maximize the opportunity.
Yeah, the takeaway that we got from this is that financial security gives you freedom and flexibility. It's because of how sound his insurance business is that he can go make the investments and he can do. It's the same way in our personal financial lives. A lot of folks in the middle of the COVID downturn from an investing perspective got really, really excited because things were depressed. There were opportunities. It's those folks who had some money on the sidelines or had an ability to save more, to put more to work. They were able to capitalize on that opportunity. If you have a solid, secure, foundational financial footing, it's going to set you up to take advantage of opportunities.
Well, cash is super unsexy and doesn't yield a lot of money. But like you said, in the pandemic, when markets lose 30 to 35% in a matter of weeks, that cash can become one of the most valuable resources you have because it becomes essentially an opportunity fund.
Absolutely.
So take advantage of that. Understand financial security gives you the freedom and flexibility to create the best version of your financial life.
So then that leads to life lesson number 5. Risk is risk. Don't let your current circumstances convince you otherwise. Don't let what's going on now allow you to misplace where you fall on the risk spectrum or where you should fall on the risk spectrum.
So Warren talks about in this year's letter to shareholders that bond investors, I've already made the previous point, it's just a scary time with bonds because interest rates, who knows what they're going to do.
Sure.
But more than likely, there's some inflationary pressure. They could be going up in the near term. Nobody knows when, though, because we've been ringing that bell for a long time. But it is one of those things where I think insurers having to make some tough decisions, and they had a quote, Bo.
Yeah, Warren said some insurers, as well as other bond investors, may try to juice the pathetic returns that are presently available by shifting their purchase to obligations backed by shaky borrowers. Risky loans, however, are not the answer to inadequate interest rates. 3 decades ago, the once mighty savings and loan industry destroyed itself partly by ignoring that maxim. What he's saying is, just because rates are low and just because yields are low, don't think that you ought to go out on the risk spectrum to try to make up for that. And we see that with clients, with prospects, with investors right now who say, yeah, cash is trash and bond rates are so low, I'm just going to be 100% portfolio. I'm just going to, or you know what? If I'm going to have bond exposure, I'm going to go out and buy these high yield junk bonds because I can get more. I'm going to go buy international. I'm going to go all over the risk spectrum. While there may be a place for that in your portfolio, don't lose sight of what those pieces of your asset allocation are supposed to be doing.
Yeah, I'm amazed in our comment section where people will share they're in their 50s and 100% of their assets are like in a total market index fund.
Yep.
And I'm like, I love a total market index fund, but it's not where I want 100% of my assets when I might need this money quicker. There is this thing called risk capacity, not just risk tolerance. Pay attention to that. And the more stable you are to understanding the financial order of operations and having your financial life built on a rock, not on the scary sand of volatility, you will be better prepared to really hit this takeaway. And I picked on you, Bo, about this takeaway because here, I'll just read it. This is what, and I'm going to pick on you because you wrote this part.
I did write this one.
Let your risk on assets be risky, and let your risk-reduced assets be less risky. And I was like, wow, that sounds like a Captain Obvious quote there. So kind of explain, what do you mean by this?
Yeah, again, if you're going to have an equity and a non-equity portion of your portfolio, a stock portion and a bond portion, let those things do what they're supposed to do. If the reason you're allocating to fixed income or the reason you're allocating to alternatives, the reason you're allocating to risk off is to remove risk from your portfolio, maybe the thing that you don't need to go do is go buy emerging market sovereign debt to try to juice the yields on fixed income. If you want to have equity-like returns, invest in equity-like investments and let your conservative risk-off part of your portfolio actually be conservative risk-off. When you begin to blend those and mix those together is when we get into times like 2008, times like fourth quarter 2018, times like the COVID downturn. We say, holy cow, my portfolio I thought that was well diversified perhaps is not quite as well diversified as I thought it was.
Okay, I give you credit. That sounds better than the Captain
No,
Obvious.
I think that's a good one. That one should go on a t-shirt. Hey, Ruby, put that one on our t-shirt, please.
Number 6, if it ain't broke, don't fix it.
Yeah, this one is a really, really interesting one because Warren, in his letter, he begins walking through some of the companies that he's acquired and what I would call some of his big winners.
Yeah.
Some of the ones that have done really, really well.
And it's diverse. I mean, we got See's Candy.
Yep, that's right.
I mean, and then we got Geico Insurance. I mean, those are completely different businesses.
Yep. And so as he's talking about the things that he learned in sort of working with these companies, I love how he talked about Mrs. C, who was the founder of See's Candy. He has this like long quote where he kind of opines on, but essentially he gets down to this bottom line idea of don't mess with the candy.
Yeah.
Don't mess with the candy. Let the candy do what the candy does. Don't just because you're trying to come in there and Berkshire acquired the company and Berkshire has all these different things they could do. He didn't want to go in there and start meddling and telling her how to do her job and try to fix something that was not broken.
It is one of those interesting things that I see, and he has another quote, and I'll let you read that quote here in a second. But I think that there is something very valuable that if you have a winning recipe, meaning because that's what See's Candy, it's great candy, it's working. Don't go screw it up. And I see this in people's financial life all the time. Is that they're winning. They have a good income. They have the good behavior of saving for the future. By all standings of looking at the scoreboard, looking at what they've created in life and what they've saved, they've won the game.
Absolutely.
They have to kind of actively try to screw it up, but I do see people do that.
Absolutely.
I mean, we see it not only with celebrities, we see it with athletes, we see it with savers where they'll go do. We even have a life story where we had a landlord, super successful, pretty much had every trapping that he should, but then he supported a child's business, a family member's business, and that business ended up pulling all of his assets and pulled him away from the grasp of success and victory. So Warren he had a quote, and he talked about Phil Fisher.
Yeah, he said in 1958, Phil Fisher wrote a superb book on investing, and he analogized running a public company to managing a restaurant. If you're seeking diners, he said, you can attract a clientele and prosper by featuring either hamburger served with a Coke or French cuisine accompanied by exotic wines. But you must not, Fisher warned, capriciously switch from one to the other. Your message to potential customers may be consistent with what they will find upon entering your premises. At Berkshire, we've been serving hamburgers and Coke for 56 years. We cherish the clientele this fare has attracted. What I think is so interesting is when I think about personal investing, I see so many folks that start their career and they say, I'm going to max out my 401k and do my Roth, and I'm going to just buy low-cost index funds. I'm going to build my portfolio, and I'm going to build $200,000 and then $500,000 and $750,000. I get to $1 million, and then all of a sudden I get to $1 million. And for some reason, I got to go do something else. I got to go get in a private placement. I got to go get in some limited partnership. I got to go buy some master. I have to do something else that complicates it when in reality, the very simple cheeseburger and Coke was working just fine. They actually end up trying to outsmart themselves.
And so there's a key takeaway there, and I think we can bring this back once again to financial order of operations, is that if your plan's working, don't outsmart yourself.
Absolutely.
And that's, once again, if you go to moneyguy.com/resources, we have the financial order of operations, the 9 steps. Don't think that success has to be sexy or sophisticated and pull you from the basics, because you nailed it, Bo. I mean, I see people all the time, And I don't know if it's a flex, I don't know if it's pride, but you have this plan that's working, but then you have a little bit of success and you go, well, this must be what rich people do.
I got to do something different
and
now.
then you get into some type of risky endeavor that you just rue the day that you ever heard that sales pitch that took it away. So just be very mindful, because wealth building is surprisingly simple, but yet it is very far from easy for the majority of the public.
That's exactly right. The next one, the seventh life lesson, and this was a really interesting one. I thought he did a great job. This is in the words of Warren himself: never bet against America.
Now, he put the A in there.
He did.
I mean, that one's almost like a slogan on a T-shirt. Yep. Never bet against America. I mean, that's what. I mean, even and Daniel put together a cute girl holding an American flag. I think that's awesome. This is another one of those I talked about earlier. Warren has several themes he always puts in the letter to shareholders. One is being a contrarian. Another is do not count out America and the innovation, the spirit of success that seems like we have with creating opportunities here.
And what I think is amazing is that, in my opinion, no one can quite tell a story like Uncle Warren. And so he kind of walks you through some American success stories. He walks through Jack Ringwalt of National Indemnity, Rose Blumkin of Nebraska Furniture Mart, Jim Clayton of Clayton Homes, and then Jim Haslam of Pilot. And he kind of tells you the stories of these entrepreneurs and the businesses that they started, founded, or ran, and what they turned into, and how they were able to take a little bit of risk, a little bit of opportunity early on, and turn it into something absolutely incredible.
And he even put a quote in there. Go ahead and read the quote to him too, Bo.
He says, today, many people forge similar miracles throughout the world, creating a spread of prosperity that benefits all of humanity. In its brief 232 years of existence, however, there has been no incubator for unleashing human potential like America. Despite some severe interruptions, our country's economic progress has been breathtaking.
Well, I think this is good for everybody to listen to this, because a lot of you will say, look, the stock market's been on a tear for the last 10 years. Do we even count 2020? Because, yes, it lost 30 to 35%, but it made it back so quick, you can almost forget it.
Sure.
So a lot of you guys are calling the top. You're saying, man, we have nowhere to go but, down. So why would you go into the stock market? And I want my young people especially, because you just don't have enough time or experience in the markets that you could hear somebody tell you that. Or hear an older person who doesn't understand how the financial markets work and don't realize you're buying into the prosperity of the future instead of playing the stock market like it's some type of casino game. It's nothing like that whatsoever, and you could get dissuaded into letting your dollars work. And that's why we have a key takeaway, which is it's not slowing down. And I specifically asked Daniel to put the SpaceX rocket in the background. I mean, we could have put the COVID vaccine on there. I think there are so many things. If I look at when the first iPod was announced, I mean, I've got my iPod behind us.
Here on the wall.
And then you think about like the iPhone came out, I think in 2007. I mean, and then the iPad, and then you look at we're landing rockets back. They're coming back where they came from. I mean, guys, it's amazing the world we live in. And by the way, it's not slowing down. Innovation is actually accelerating. And here's what I get excited as being a capitalist that figures out how do you take and invest money and turn a little sliver of that opportunity, of that success into your own financial opportunity and success for your family. It's just mind-blowing how easy this is in today's time with index funds, investing, low cost. It's exciting.
And I think sometimes we get lost in the currentness of today, and we forget it actually is accelerating, and there's proof in that. If you want to look at like technical innovations, thank you, Daniel, for this, dating all the way back to like 3000 BC, you can see that things moved fairly slowly, right? Technical innovation.
Now, wait a minute. You went through that way too quick because we have podcast listeners too.
Okay,
so we have to slow down because it
down.
needs to not only be a visual element, this needs to have some audio components. Up until, look at 3000 BC is when papyrus was invented. The first time we could write.
Sure.
And then we had the pyramids sometime between 3000 BC to 2000. We had the pyramids, which nobody really knows still how they did that. Pretty amazing back then. But then fast forward thousands of years and then past, we get to AD, and you can see the printing press was invented in 1440.
Okay.
So it took us a long time to pound out papyrus and turn it into where we actually have a printing press and can automate printing. And then you fast forward a few more hundred years, it's not until 1793 that we have the cotton gin. So you can, separate the seeds from cotton so you can manufacture easier. This is hundreds of years. And that's why we have slides with only one or two things on it. And then fast forward into the 1900s, when you look at the 20th century, you're like, whoa. There was a lot of stuff that happened in the 20th century.
Yeah, I think what's incredible is Warren talks about how the economic progress that has taken place over the last 232 years in this country has been amazing. I'm one of those folks. I'm of the proponent. It's going to get even more exciting, and I think it's going to continue moving more fast. And I think this is an amazing time to be alive for the things that we will see 5, 10, 15, 20, 30, 50 years from now. I mean, I remember coming up through school, like getting used to like the internet and computers, and now I have a smartwatch on my wrist that can basically do anything I want it to do. It's unbelievable. I don't think that that's going to slow down.
Well, I think you could make the assumption that it's compressing, and the fact that what was 1,000 years, we had more innovation in 100 years. Now you're going to see what happens. What normally it would be in the 20th century. What took 50 years worth of innovation, you'll see in a 5 to 7 year cycle. So this thing is actually accelerating. As long as we don't create artificial intelligence that kills us, we should be all right. And there's going to be an opportunity for you to take a little bit of your time and your labor, invest, and turn that into that great, big, beautiful tomorrow. That's what we're talking about with creating success for yourself.
And what I think is interesting is that the level and the speed of innovation and the access to it that we all have creates kind of another exciting acceleration. If you look at the number of millionaires in the United States, now this is just back from 1997, so right before Y2K, all the way through the end of 2019, even that has accelerated. In 1997, there were 5.3 million, not 5.3,
millionaires.
5.3 million millionaires. And then in 2010, there were 8.4 million millionaires. And then as we closed out 2019, there were 12.7 million millionaires. And now, yeah, some of this can be accounted for inflation before you come out of those steps, but not that much. This is because people are having access to be able to invest and grow and participate in this innovation that's taking place. It's just like he says, it benefits all of humanity. What we're seeing, we've seen this like firsthand here in the United States.
So get excited for the future. That's what. Be an optimist. By the way, we have an upcoming show where we survey our successful clients, the millionaires that are amongst us, and guess what? They're optimists, guys. This is confirmed. Get excited about what the future holds for you and your financial security. Let's talk about number 8. Believe in what you do.
Yeah, this one I thought was interesting because I always love when Warren goes back in time, and he kind of, and I think this has got to be just a result of his age. I feel like in most of his recent shareholder letters, he's been telling the story of way back when he founded Buffett Limited Partnership, and when he did those sort of things. And what I think is so interesting is Warren kind of, again, you can kind of read through it, but he walks through, hey, when I started this investing deal, I had a group of doctors that I was going to help them manage some money for. Well, as this thing got some steam, not only did I have like this group of doctors, I had my friends, I had my family, I had my colleagues. I let everyone be a part of this. Man, you better believe in what it is you're doing if you're going to wrap in those folks that are closest to you to be a part of it.
Well, I think this thing, I'm going to get even deeper. I mean, the old sentimental guy on the show, so I get a little more latitude. We've done so many shows on happiness and what creates fulfillment ultimately. Because we all talk about we want happiness with our money, but really what we're asking for is fulfillment.
Sure.
And what fulfillment, a big part of it, is you wake up every morning and you feel like in your own little way you're making the world an actual better place for what you're actually laboring on or what you're working towards. That's why you hear so many people have the goal of, hey, when I retire, I think I'm going to go volunteer.
Yeah, yep.
You know, because they think they want to, in their vision of fulfillment, of happiness, taking a little bit of their time and paying it forward is what creates that spark.
Yep.
If you can do this with your everyday life, you will not only be happy, you will be fulfilled, and this will be something that I think you should question. Hey, do I really believe in what I'm doing every day?
Yeah, the takeaway is if you wouldn't recommend what it is that you're doing to others, it may be worth rethinking. Whether that is a vocation and a job that you do, or even the way that you manage your finances. If the decisions you make around saving and consumption, is that something you'd recommend to your son, your daughter, your aunt, your uncle, your mom, your dad, your neighbor? If the things that you're doing aren't reflective of what you would recommend others to do, maybe it's time to do a quick self-evaluation. Am I doing exactly what I'm supposed to be doing?
Well, and I'll give you a data point.
Sure.
Ramsey Solutions does some of the biggest surveys of millionaires and successful people, and in their research, they found 96% of millionaires said they enjoy what they do for a living.
I love it.
I think that's fulfillment. You know, and so that's the big takeaway is understand, believe what you're doing. And as Bo said, if you're questioning about that, because we see that with career changers. I mean, we have financial people say, hey, I want to be a financial planner, but I felt like all it was a product salesman.
Stuff, yeah.
So that's why I'm interested in working with you guys. I think you see the big picture, and we're blessed that we get to, with the abundance cycle, get to pay it forward, educate you guys through the Money Guy Show, and it's just this beautiful cycle that keeps working. So that leads to kind of number 9, a good closeout one is behavior matters.
Yeah, this one, you know, Warren talks about in the letter to shareholders the different type of people that invest in Berkshire Hathaway. He's like, okay, you know, there's the institutional folks and there's the pension folks, and
he throws a little shade.
There's those folks, right? He then says, oh, there's these transient folks that like want to buy and trade stuff. And then he says, you know, there are the investors. They're the folks who believe in what we're doing, believe in what we have put here. And he starts throwing some shade specifically on that bucket that he calls the active traders, active investors.
I thought it, because we have a funny little thing, and Daniel got so excited when we were doing pre-show planning. I thought for sure we were going to have a picture of a blindfolded monkey. But there's a quote, Bo. I want you to kind of go ahead and read the quote Warren has, and then we'll talk about this research that Warren kind of references.
This is what he says. He says, after all, ownership of stocks is very much a positive sum game. Indeed, a patient and level-headed monkey who constructs a portfolio by throwing 50 darts at a board listing all the S&P 500 will, over time, enjoy dividends and capital gains, just as long as it never gets tempted to make changes in its original selections.
So I love it because Warren's shown his age a little bit, and I'm long tooth enough that I can remember. This was from back in the early 2000s.
2001 is when
there was a
started.
research study where, Warren didn't mention this, but the monkeys were actually blindfolded. Now, I get a visual of the poor laboratory person that was in charge of blindfolding monkeys. I mean, that's weird. I was like, they could have just had the monkey throw darts in general, but they're like, you know what?
It's not like they were reading this tape.
They're
right?
like, we need to kick this up a notch. It's just not enough. Monkeys picking stocks is not enough to really show how active management doesn't work. Let's blindfold these things. Because obviously, if they can have their eyes, the use of their eyes, this is a no-brainer. They're going to win. So let's make it even harder. And that's what the research does show in a lot of terms, that it's, why should you? The market is very efficient in a lot of ways. You could actually do much better just buying the market instead of trying to outsmart it and buy active management.
And what I think is so interesting, at the tail end of Warren's quote, he puts this thing in there that if you read it too fast, you'll miss it. He says, just as long as it never gets tempted to make changes to its original selection. That's the difference in an active and a passive trader, is the one who's trying to make changes, trying to go find the next thing or move into the next position. And we actually have statistics that verify how futile of an exercise that can be. If you look at the SPIVA survey from 2020, and how often do index funds beat their active manager counterparts, and this is measured over a 15-year period, what we found is that what SPIVA found was that 87.7%, almost 88% of active managers underperformed their index. Rather than just going out and buying the market, the ones who wanted to try to pick and choose investments and move around and select it, 88% of those underperformed over a 15-year period.
Well, I think here's the thing. We have this data as of 2020. That article that we just had up on the screen from the Wall Street Journal about the blindfolded monkeys was from 2001.
Yep.
So sometimes the trolls come out from under the bridges and they say, guys, you're cherry picking the period here. You're using the last 15 years. The stock market's been crushing it for the last 10. You are cherry picking the data. Guys, I just showed you. They're blindfolding monkeys in the 2000s, early 2000s, and still outperforming the active managers. This is not a new phenomenon. And the reason is because of fees. It's because of, there's a lot, it's the behavior. It's that last sentence you read where as long as it never gets tempted to make changes in its original selections, sometimes we outsmart ourselves. Just be a lazy investor and let the money work for you. And
this isn't just true in large cap. If you look at mid cap managers, 82% of those underperformed their benchmark. Small cap managers, another 82%. So we're seeing that like on the domestic equity side, it's not a horrible thing to just buy the index instead of trying to beat the market, just be the market. And then what I thought was even really, really interesting, as of the SPIVA 2020 survey, 88% of active international managers, so not domestic equities, international, underperform their stated index. So even as we're getting into bigger, broader asset classes, index investing is not a horrible place to be. It's not a bad place to be if what you want is consistent long-term performance.
Well, I want to go outside the scope of whether we're talking about large cap, mid cap, small cap, international, and just talk about in terms of investing, period. First of all, you should not have anything in the financial markets unless you can leave it alone for 5 to 7 years at a minimum, because so many people who don't have the experience, don't have the depth of knowledge, they will buy in and they'll be like, oh, I'm the unlucky charm because market lost 6% right after I invested. And when they don't understand the full grasp of what investing is. Investing is walking up a mountain with a yo-yo. And we actually have this awesome slide that Daniel created that makes me think of The Price is Right every time I see this.
But
you do have, as you are walking with that yo-yo up the mountain, it's going up and down in the short term. But you're going to higher and higher elevation over time. So yes, 3 years from now, the stock market might actually be lower than where it is today. I don't actually know that. I'm just saying it could be. But I do know if you fast forward a decade in the future, there's a very good likelihood, very strong likelihood. I'm talking in the 80s, 90% range that historically, the market is in a higher place because of that ever-expanding economy from innovation and other things. That's why it's great to be a long-term investor.
And the key is the behavior. The key is understanding that it is a walk up the mountain. Every time that yo-yo string goes down, you don't freak out. You don't sell. You don't change. Or every time it goes up, you're not trying to go up a little bit higher and try to get out in front of it. And I thought Warren did a beautiful job dropping a bomb in there that I want to say is a Money Guy echo. I don't know that he got it from us, but maybe he did.
I do feel like there's an echo in there.
There's
an
echo for sure.
Or it's the fact that good financial management, guys, because I get the comments from time to time, God, y'all talk about this concept all the time. And I even told this to the content team. I was like, guys, there's really only 8 important concepts in finance. But we have to repeat them over and over because the people do not do these 8 important things. But we have 3 wealth creators, and there's an echo in Warren's last comment.
Yeah, this is what he said. He said, productive assets such as farms, real estate, and yes, business ownership produce wealth. Lots of it. Most owners of such properties will be rewarded. All that's required is the passage of, listen up, time.
Check.
And inner calm. We're going to put, in parentheses, discipline.
Check.
Ample diversification and a minimization of transactions and fees, parentheses, money. You need money to do it. Still, investors must never forget that their expenses are Wall Street's income, and unlike my monkey, Wall Streeters do not work for peanuts. So you have to keep an eye on those 3 things: time, discipline, and money.
And that's why we spend so much of our time on creating content that is really respectful to these 3 concepts, because that is the takeaway. Wealth creation has these 3 simple ingredients. When I talk about discipline, I'm talking about the fact that you live on less than you make. That is the first thing. I'm talking about come out of the gate, graduate college, or just start working in your first official grown-up job. If you're spending 100% of what you make, or if you're spending 105% of what you make through credit cards, you will never, ever, ever be successful and wealthy financially.
That's right.
So you have to have discipline first by living on less than you make. That behavior will then create money. That excess allows you then to deploy the money by investing, and then that is the most important part, giving it enough time to actually nurture and grow. You know, when we try to look at a big live oak, you plant a live oak. If you looked at it year over year, you'd be like, that thing's not really growing.
Yeah.
But if you look at it every decade, you're going to be amazed at how much progress. And your portfolio is the exact same way. And that's why you're trying to build it to that critical mass. So then one day you wake up and you go, holy cow, I don't know what I did other than I was disciplined, other than I tried to always make sure I had money working for me by investing. And then look at this. It's almost like a magical recipe. I wake up with enough time, and now I've built success, I've built wealth, I've built abundance for my family.
What I think is so amazing, Brian, is I have to believe Warren, as he sits in his chair right now, he's thinking about that oak example. And you look at what he's created in terms of his own personal wealth, or you look at in terms of what Berkshire has created in terms of like the enterprise wealth that Berkshire contains. He hasn't been changing what he's been saying. For the last 70 years, he's been giving the same advice and doing the same things and behaving the same way. And it's amazing how consistent that tried and true behavior, that tried and true not letting yourself go off track, what it's done for Warren and what it's done for Berkshire. Now, for us personally, maybe we're not going to build net worths into the billions, into the multi-billions. But even in our own world, with our own shovels, with our own paychecks, with our own families, building wealth is surprisingly simple. We make it harder than it has to be, but it's simple if you can just stay consistent and do these things that Warren talks about year in and year out.
Guys, thank you for joining us. I love this annual tradition we do. We're going to keep dropping nuggets. I hope that Warren has another 25 years of creating this type of content. We can get him in Guinness for the longest streak of writing the Berkshire Hathaway letter to shareholders. But it is, you know, you're probably, if you're brand new to our content, you're like, man, these guys are, you know, they're dropping some bombs there themselves of nugget knowledge. And I would tell you that we do this off of the abundance cycle. I've had the heart of an educator since the mid-2000s when I first started podcasting. And you're like, well, what's the catch? How can these guys just give it away? And it's called the abundance cycle. You come, learn, and we know it might take years. It might take decades, but you're going to come learn, apply. You're going to grow everything we're sharing to one day you'll reach a level of success that you go, holy cow, those guys did it. Just like they were talking about discipline, money, and then time. Here I am. This thing's gotten complicated. I need a co-pilot to help me figure out what the next step is. That's when you'll remember who planted the seeds, who put that live oak in your backyard of wealth creation, and you'll come back to Abound Wealth. And we work with clients all across the country because of that mentality and because we ask absolutely nothing of you except go become successful.
If you've not gone out to our website, if you've not checked out moneyguide.com and you've gone to our resource page and seen all the things we're making available, if you've not had a chance to go read our blog posts, if you want to know more about the wealth management firm and go to aboundwealth.com, make sure you're checking out those resources. Make sure you're using those so that you can take your finances to the next level.
Guys, thanks so much for hanging out with us for a while. Money Guy team, out.